It's an absolute delight to welcome in Vikash Kumar Jain. He's Head of Research and Strategy for India at CLSA. Vikash, so good having you as always. Thanks for taking the time out. I hope all is well.
All's well. Thanks for having me, Neeraj.
The pleasure is ours. Vikash, I would love to start off by asking you if you are constructive at the current context, considering 3 or 4 things have happened, right? GST 2.0, apparent thawing of the relationship between India and the US, and now the Fed showing its hand for not 1 but 2 more rate cuts in the near future as well.
Sure, I think so. The number of negatives that our markets face has clearly come down. If you look at the last 6 months, we were facing a lot of negatives, and that has come down. So, I mean, from a very tactical perspective, we could definitely have a period which sees some relief, some hopes of positives over the next few months. So, from a very tactical perspective, you can argue that things are looking much better than what they have looked over the last 12 months.
Sounding, therefore, very constructive over the medium term, Vikash, because you're specifying that it's only tactical and it's only for the very short term.
Yeah, I mean, because, when people, this is something that people keep asking, how are you feeling about the market? I say that, I can be bullish and bearish. So it depends on, don't confuse, don't say that I'm trying to confuse you. I'm just trying to talk different horizons. Some of the medium term worries are still there. And most of those are stock market worries, expectations running ahead of themselves, continuing to see, valuations quite, haven't really come off. But there were several other worries which were, all compounding together. Those are now at least turning into relief, like you said, thawing of US-India relationships. Fed rate cuts, what it does is a very important thing. Hopefully, it just gets interest back into EM, and EM outflows possibly stall. If that stall, then the necessity of foreigners selling India comes down. At the same point of time, we could also get into, after this period of pause, after several rate cuts by RBI, again, more rate cuts coming maybe sometime in this quarter. And then the host of actions taken to boost consumption, which is GST, even the impact of all of these previous rate cuts plus the more coming, and also, the income tax cut at getting tested around the festive season. And one most important thing, and very tactical again, is there is an expectation already that many of the consumption-related sectors, where there was an expectation of rate cut, would see clear impact on sales in this quarter. Therefore, what that has done is that it just takes away the focus from this quarterly results. So that's a relief, because what we have seen is earlier, last 3-4 reporting seasons has been the worst period. For example, the last one, six weeks, all 6 weeks being negative for Nifty is a rare thing. That happened in the last reporting season. All of the 6 reporting weeks were negative. So at least this time, the market is already assuming that there will be negative. So the impact of results will be much lesser. So somehow some relief to watch out for over the next few quarters, next few months, ideally this quarter. That should be, what maybe we need after 12 months of negative performance.
Yeah. Vikash, very good morning. Tamanna here, and great to speak with you. Your outlook for Nifty for the year was a single-digit return. Does that change at all? Do you see any effective change because of GST cuts? Because there are various theories doing the rounds of how much momentum will be built in. Curious to know what your take is.
Yeah, so if you look at even the month of August, it was actually a bad month for the market. India was the worst performing equity market in US dollar terms amongst all the large markets in the world. However, what happened was autos and FMCG actually did pretty well. So I think what happens is more sectoral, because effectively the government under its third term has actually doubled down on consumption. So Modi 2.0 was much more about capex. Even during COVID, when rest of the world were getting consumption related packages, more money in their bank account to spend, we were pushing self-sufficient India, Atmanirbhar Bharat, and a lot of those capex reforms. But Modi 3.0, if you see, has been far more focused on consumption for whatever reason. Maybe that's the need of the hour, and but I do not think that positioning has shifted that dramatically in favor of consumption after even if you remember what we had coined as Modi stocks, which had a host of capex stocks doing very well in the lead up to elections. I do not think that they have become that rank underperformers yet. So I would say the big move is more at the sectoral levels. A more unequivocal move towards consumption is what investors need to do, and they need to do it fast if they want to outperform in this market.
Wow. So when you say move to consumption, Vikash, it's a big basket over there. What specifically do you think is where that move can be generated, that upside can be generated, as you have a larger number of aspirational Indians? Are you looking at the discretionary space more favorably, as many analysts are?
Yeah, so I would say that when people recognize the need for this move, for consumption, it might very well be, a good tide lifting all boats. But within that, of course, some areas of discretionary autos is one sector we went overweight a few months ago, before even GST came in. That could be one area. There could be other areas of discretionary as well. But I would say that selectively, even some staple names, wherever competitive intensity isn't that big, relatively, could still be doing very well. So I would say consumption in general should be the focus area for this tactical rally that we are talking about.
Got it. Vikash, what do you think of tech at large? I mean, does the Fed worry about the labor data mean that corporate health in the US may not improve, or is it to the other side? And therefore, could Indian tech perform on expectations of enhanced corporate spending in the US led by the Fed rate cut, or could it be the other way around?
So Neeraj, I think stock market mood will depend on how every announcement is taken by the Fed. Right now, the Fed announcement has been taken as perhaps an action taken at the right time before things go out of hand in terms of growth and unemployment. Therefore, it would be seen as something which should be able to keep growth at at a reasonably strong level in the US. So I would say that it basically arrests the fear of a potential growth deceleration, which could have happened without the rate cut, is the opinion what the market has taken. Unless data worsens, that is, so the most important data effectively becomes the data that comes out on the first Friday of every month, which is the unemployment data and the labor payroll data. So that becomes the most important data. If one of those days there is a big bad data, then suddenly the market opinion might change as that Fed is doing too little too late. So till that happens, this is to be seen as good for US growth, and therefore it will be seen as good for the IT sector. In fact, one of the reasons why IT has been a little bit of a pain for us. We went overweight, I think 3-4 months ago. We were not able to predict how US-India relationships could actually worsen. And that's why it has impacted us. But I think going into towards the end of this year, and with a couple of more Fed rate cuts likely, there is likelihood that this sector comes back in action. Valuations are far more, I would say, palatable now in that space now. So that is another out of consensus overweight that we have in our portfolio.
Yeah, but Vikash, I mean, you're not alone. I think out of 800 crore people in the world, 799.99999 crore people were not able to predict how the US-India relationship will go after Trump's tweets, right? So you're not alone out there. The other interesting thing that I saw, and focusing on a domestic sector, was yesterday's call from your end on the upgrade, if I can use that term, on cement. Now, it's interesting, right? I mean, what's the base thesis? Is it that pricing power will come back now that the industry is consolidated? Because I think the last 10 years, the cumulative price is up, what, 5, 7, 10% maybe? So what's the thesis? Is it pricing or is it something else?
So it's multiple arguments over there. First is, slightly longer term argument. Uh, Depending on the larger players that you look at, and I mean, there's the upgrade that you're talking about was one of the larger cement players. They get into some kind of a moat around the end of this decade with the changing rules around mining and mining regulations kind of coming in. So that is something where they get into some kind of a mode. By that time, they would have increased their capacity quite significantly. So there's a host of this big capacity expansions which they will benefit from. But more from a near term, I think if you were to look at where pricing has kind of steadied and what we believe could happen in terms of typical seasonal pricing, there is likelihood that there could be surprise versus what consensus is baking in. Plus, even from a GST perspective, there are some changes that have happened, which kind of makes their position a little bit more justifiable. Like earlier, there was this particular cess that they had to pay for a key input, which they could not get credit for. So that goes away. So now, they effectively their net, effective costs would also kind of come down. So that just improves the margin situation as well. So it's a combination of host of things which kind of makes the sector pretty attractive. Plus, from a top-down perspective, materials as a space was also seen as one of the areas where earnings growth was seen to be pretty strong. And, we were underweight on that one and using this as an opportunity. Surprisingly, the stock had not reacted much out to the GST cut. The cement stocks haven't really reacted much. We believe that it's a pretty big positive for them. And it just gives better visibility on margins being much stronger. And they have reasonably high sensitivity to even small improvements in margin in terms of profitability. So that is where I think the positive opinion came from. And that's why both the sector analyst and our changes to portfolio are more favorable towards this sector.
Would that extend to real estate to some extent? When you're talking about stocks or spaces that have not really reacted to the GST cut, or the full implication has not been folded in yet?
Yeah, so I would say less of GST, but anyways, our preferred areas to focus on from a portfolio construction perspective is consumption, and the other one is rate sensitives. So because we believe that, after a slew of rate cuts, there was a period of pause, and that's when many of these real estate and other rate sensitive sectors, some of the rate sensitive names have seen a period of consolidation. I think with rate cuts possibly coming back either in October, but most likely definitely higher chances in December. That is even our own RBI rate cuts. I think that sector will be back in flavor. Some of those stocks have at pretty good, relatively much better valuations to tap into. So rate sensitives and consumption are the tactical bets to play the upside. Given that our opinions are more tactical and I'm not really seeing very large upsides in the more medium term, we would not want to shun defensives because, to outperform, you don't really need very large upsides where we are, in the market. So defensives, consumption, and rate sensitives is how I would look at things from a top-down perspective.
Curious to know how you're thinking about platform players, and Eternal comes to mind. You don't have to talk about it specifically if you don't want to, but that's the dream run right now, right? Everyone is very, very constructive. There is one sense also, one POV, that is the profitability comfortable enough? Is the growth story really keeping in pace with what the valuations are? What's your view?
So our view has been, and we've done a lot of work around quick commerce in general, is that this speeds up the move to organized retail from unorganized. It's basically, if we were to look at what typical old style organized retail players were offering, they were offering value. And however, they were lower on convenience as compared to mom and pop stores. I think quick commerce, where it fits in, it kind of offers better value than mom and pop stores and even more convenience. So there's a segment of the market which will be willing to pay for that convenience and maybe also get some value out of it. So there's definitely a lot of promise in that space. Now, that's a reasonably long drawn kind of opportunity which is here to stay. But there will always be periods in the middle when, for competition, for some other regulation, for other reasons, there will be ups and downs in that, in stock prices. And the argument on who's going to stay to play that, to capture that big part of the opportunity, will it be all the players who are there? Will it be only, one or two players? So those debates will continue, but over the longer term, we really like the promise. We really like the space. There will, of course, nonetheless be hiccups in the short term in terms of way arguments move here and there.
Got it. Vikash, such a pleasure talking to you. Thank you so much for taking the time out. I must say though, your and Damien's note when on platform and internal created quite a stir. We did a couple of pieces on that, and they were quite a raging hit. So thank you so much for writing so well.